Welcome back, grade 12 students in accounting. So I wanted to just go through a quick recap of what we've learned so far and the big picture items before we transition into the e-learning environment and what's next. In grade 11, you would have learned about debits and credits and how to just overall do general journal transactions. Moving on after that, you start into the grade 12 course where we quickly run through the accounting cycle. Things like the gaps and how they end up affecting our accounting practices, the recording process, and then they extend a little bit further into the adjusting entries like prepaid accounts, as well as unearned revenues and adjusting entries, as well as closing the accounts. So essentially, Unit 1 is a recap of grade 11 and all the essentials that you need to use before continuing into the new stuff. We've continued into Unit 2, which is accounting practices for assets. Specifically, we've been focused for the past month roughly on merchandising operations and merchandising businesses, things or businesses which buy and sell goods. Merchandising operations goes into how we deal with our merchandise, how we end up dealing with cost of goods sold, how do we record that sale, and adjusting the closing entries. We've got gross profit and cost of goods sold that comes into play, and how to actually analyze those as a profit margin or as a gross profit margin, and what those mean about a business. Inventory quantities and how we adjust at the end of the cycle, as well as cost flow assumptions, LIFO, FIFO, and average, and how those different cost flow assumptions affect the business. So how does it affect the financial statements? Does it end up increasing them, seem like they're higher or lower? And making sure that we're still applying the gaps and that we make sure we are consistent, that we can't just change our financial statements based upon who we want to see or who we're going to present them to, but that they should be consistent for all users. Those users being generally the government, business investors, as well as the people running the business. We've looked at liquidity ratios, how liquid something is, and we've started into our inventory systems, perpetual versus a periodic. So perpetual meaning that we are continually updating the inventory system as things are scanned, and how technology has enabled us to do that. Regardless of the inventory system, we are still required at the end of a cycle to do a physical count. We've moved into accounting for receivables and how we end up adjusting those, as well as we are now going to start into uncollectibles. What happens when the accounts receivables we're not able to collect on them? How do we end up journalizing transactions for that? And what's the difference between accounts receivable and notes receivable? We're going to look at our analysis of those different kind of receivables and what they mean about a business. And after we're done with the receivables and notes receivable and adjustments, things like that, what you do start to realize out of most of the stuff we do in accounting, everything is revolving around the time period concept, which is that you have to try and match up your revenues and your expenses according to the revenues that they brought in, and you have to try and do it in such a way that they are kind of allocated towards a period. So that's what we've done so far. Plant and equipment, we're going to have a look at that and how we end up doing things like basket purchases. In the real world, we're going to buy properties, and those properties, well, we have to depreciate parts of them. Land generally does not depreciate, but buildings do. So you have to look at it as a basket purchase where you're going to divide things up according to the depreciation of the property, and then land is kept separate. So we'll look at that. What percentage was land? What percentage was the property? Amortization methods is something that you should have touched on in grade 11, and we'll be coming back to in a little bit more detail. Things like double declining balance, straight line balances. And in the real world, what you will find is a lot of this stuff is determined by the tax regulations of the country. For example, if you want to do something in the US, you'll have different classifications. For a property, it will be considered something like maybe I think it's class 1. I think they go in numbers, and I think in Canada they go according to letters. Don't quote me on that. I might be a little bit rusty on it, but for the most part, you throw in your capitalized value of a property, or an asset, and the tax software will generally start to calculate the depreciation for you. You just have to keep track of what the asset's actually worth. But there are some things. What about property which is depreciable? What about things like natural resources? Suppose you have an oil patch or you mine gold. Natural resources, how we end up dealing with these things, as well as intangible assets. And at the end of this unit, we'll be going into asset ratio analysis. So we do the accounting of it, and then we look at how we're actually going to analyze a business according to its assets. So that being said, we'll start to go into our new lessons. Good luck. And if you have any questions, I'm always here to help you.